When banks begin sounding the alarm, that is never a good sign. And over the last couple of weeks, there has been bank after bank raising red flags when it comes to things like lending and the general economy. Earlier this year, Wells Fargo, one of the largest home mortgage lenders in the United States, decided to step back from the home mortgage business. According to Bloomberg, U.S. bank lending declined by the most we've seen on record in the final weeks of March, with a $1.5 billion lending drop in just 2 weeks. And just last week, Capital One announced that they would be exiting their floor plan lending program for dealerships, a big sign that profitability is shifting for new car sales. Now, what floor planning is basically the process of acquiring inventory for a dealership showroom floor or dealership lot. And whenever we talk about the role that Capital One played with floor planning, is they would oftentimes fund these floor plans for these dealerships. So this is essentially a form of commercial lending specific for dealership inventory, because whenever a dealership is buying, say, 10 cars directly from the manufacturer, chances are they're not going to be paying for those 10 cars in cash. Instead, they're going to be using commercial financing, which is what Capital One provided. So a dealership uses financing to pay for their inventory, and then whenever they sell these cars, they then pay that financing off. This is not a new business model. It has been going on for years, and Capital One has been in the business for a pretty long time. And Capital One recently announced that they'll terminate this side of the business, and a spokesperson from Capital One told Automotive News that they will be winding down the work by the end of this year. And while this closure of the floor planning business will not affect the consumer side of the lending program, Capital One did serve dealerships who would borrow anywhere between $5 million and $100 million. So the amount of money that Capital One was lending was no small amount. It was a pretty massive sum of money. But I guess the good news is, if you are the average consumer, you can still go through Capital One in order to fund your new or used car purchase. Now, floor planning is a segment of the automotive industry that's changed a lot over the years, and the profitability of floor planning really depends on interest rate. From 2010 to 2015, as interest rates were low, floor planning became a profit center for dealerships, with the average dealership only making $2,355 from floor planning in 2010 to the average dealership making $109,497 in 2015. That is quite the increase in just a 5-year period of time. Then when interest rates rose in 2018, floor planning no longer became profitable. In fact, profitability with floor planning took a complete 180, and now it was actually costing dealerships on average $82,979. But then just a few years later, there was another 180 that took place in the floor planning business. And in 2020, when interest rates were cut due to the pandemic, floor planning once again became profitable, with the average dealership making $108,395 from floor planning in 2020. Unfortunately, 2020 is the last up-to-date year that we have for the profitability of floor planning, according to the National Automobile Dealer Association. But I do think that it's safe to assume that 2021 was probably a profitable year for dealerships as well, and things probably began to take a turn in 2022 as interest rates rose. But with interest rates rising over the last year, I think Capital One obviously sees the writing on the wall. And they know that as interest rates continue to be high and as car prices go down, that the business of floor planning has become a much riskier one. This is, of course, in the backdrop of major bank failures from Silvergate, Silicon Valley Bank, and Signature Bank last month. Capital One obviously sees floor planning to be a riskier and less profitable business to be a part of, and they're wanting to get out in order to not over-leverage themselves as we head into a recession. But the thing is, this shift with Capital One isn't the only red flag that we've been seeing pop up over the last couple of weeks that indicate that banks and financial institutions are moving a bit more cautiously than they have in the past. Santander, one of the largest auto lenders for consumers and the largest when it comes to subprime loans, pulled out of a nearly billion-dollar debt deal just last month in the wake of the SVB failure. Banks in the automotive industry, the home mortgage industry, and general banking industry are beginning to pull back on who they're loaning money to, and they're being much more selective with their funds. This is causing growing concern that a credit crunch may be looming. And what a credit crunch is basically whenever there's a decline in lending activity from financial and banking institutions. It means the banks are much more selective with how much they loan out and who they loan out that money to. And as a result, it's very difficult to get approved for loans. And whenever you do get approved, they typically come at an extremely high cost in the form of high interest rates. And let's just say that 2023 is not the first time that the term credit crunch has been in the headlines in the news.
I think I've seen this film before, and I didn't like the ending.
The last time we saw a credit crunch was back in 2008, and during this time, borrowers simply could not get approved for loans, from home loans to mortgage loans to commercial loans and business financing. And while I don't think that we are at a 2008 level crisis right now, and truthfully, I don't know if we will ever reach that level of crisis, I do think that there are a lot of similarities between the looming credit crunch of 2023 and the one that we experienced back in 2008. The largest similarities come in the form of the growing consumer debt that we've been seeing over the last few years, as well as the fragility of the banking industry. And while the causes of these crashes in 2023 compared to 2008 are different, the outcome could be the same, at least when it comes to the automotive industry. I've been talking about this a lot on my channel over the last couple of months, but we heard it directly from the source's mouth when it came to that last Fed call with Jerome Powell, where he said that he does expect for unemployment to continue to rise. With rising unemployment means less consumer spending, but to an extent the damage has already been done because we have an astronomical $16 trillion worth of consumer debt here in the United States. And once people lose their job and their income, that debt stops being paid on. Once the debt stops being paid on, people default. As a result of this volatility, banks begin and have already begun to crunch credit, which means that banks are going to be much more selective with who they loan money out to, which means that car buyers will be put into one of a few categories. The first category is that buyer that doesn't really care what's going on economically. They want to buy their new or used car, and it doesn't really matter if interest rates are high or if we're in a recession. As long as they have money coming in each and every month, they don't really care about anything else. This is the type of buyer that is always going to be there regardless of what's happening with the economy, with the recession, with interest rates. They are that consistent buyer that will exist no matter what. I would also put that buyer that's sort of forced to buy a car because of unexpected circumstances into this category as well. So that person that probably wasn't planning on buying a car, but maybe they were in an accident, maybe their car broke down, and as a result, they need to buy a new one. The second group of people is that person that probably would have planned to buy a car in 2023, but they are simply delaying that purchase because of the expensive prices of vehicles and the high interest rates. In fact, according to a recent survey, 44% of consumers are actually delaying purchases of either cars and homes because of these factors. And there is a third type of buyer who wants to buy a car, who doesn't really care what's going on with the economy and interest rates, but this type of buyer cannot be approved because of the credit crunch that we're going to be experiencing. So think subprime and less than ideal borrowers. So the people with high debt to income ratio, maybe they're looking for a car that's maybe a bit out of their price range. Maybe they have other debt on their books. These are the types of buyers that are more risky, and as a result, they are simply not going to get approved for a new car loan. With the new set of circumstances with the car market, you have taken out a huge chunk of buyers that are either no longer eligible or simply no longer interested in buying a car in the current market. And this is going to have a huge impact on supply and demand, and thus it will cause prices to fall. The real question is, how long will it take to have an impact on these prices? This credit crunch is going to have an impact in more ways than one to the automotive market. And what we're seeing here with Capital One and then pulling out of the floor planning business is, in my opinion, a direct result of this credit crunch. And while at the moment we don't have waves of other banks following suit and also pulling out of the floor planning business, I do think that the message is pretty clear. The business of lending money for the sake of selling cars has not only become more risky, but also less profitable in recent months. And on the flip side, the business of borrowing money for the sake of selling cars has also become both more risky and less profitable. And the thing is, this is not a temporary change. Capital One didn't pull out of the floor planning business because they think that this business is going to be slow, less profitable, and more risky for the next 6 to 8 months. They think that for the foreseeable future, which means years in the future, this is simply a not viable business to be a part of. We are on the cusp of major changes with our economy, the banking industry, and the automotive industry. And while Capital One isn't the first bank to make a major pivot this year, they also certainly will not be the last. The real question is, who's next? But with that being said, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, I would love to hear it, so make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell, and I will see you guys in the next video.